truck market is collapsing, prices are skyrocketing, debt is mounting, and manufacturers are scrambling to survive. For years, trucks symbolized power and practicality, but in 2025, cracks in the industry are growing. Massive inventories, falling demand, and record-breaking price hikes are pushing the market to its breaking point. Who's buying $80,000 trucks? What's driving this collapse? And what does this mean for your next purchase? What's happening? Record-breaking sales often signal a thriving industry, but what if they're a ticking time bomb? In recent years, the truck market has seen unprecedented sales figures, with 2024 marking a significant milestone. Manufacturers like Ford and General Motors reported record shipments, with dealers filled to the brim with inventory. On paper, it looks like the market is thriving, but these numbers tell a misleading story. The success of 2024 wasn't entirely organic. It was heavily supported by aggressive marketing campaigns and significant discounts designed to push inventory off lots. Dealers used eye-catching offers to attract buyers, but these short-term gains masked long-term problems. The truth is, the record sales came at a steep price. A flood of unsold inventory remains, creating a fragile market structure. This abundance of inventory isn't just an inconvenience for manufacturers. Trucks sitting unsold cost money every day they occupy dealer lots. Carrying costs, storage fees, and declining value eat into profits. The paradox of record sales is clear. Selling more doesn't mean the industry is healthy. It means manufacturers are taking desperate measures to avoid a complete standstill. Understanding this imbalance sheds light on how these unsustainable sales figures set the stage for a looming market collapse. To understand why the crash feels inevitable, we need to look closer at truck pricing and its role in destabilizing the market. The impact of soaring prices. When the price of a new truck rivals that of a luxury car, it's no wonder buyers are beginning to hesitate. Truck prices have skyrocketed in recent years, with entry-level models creeping toward premium pricing territory. Imagine walking into a dealership and seeing a mid-tier Ford F-150 XLT priced at over $75,000 or a top-of-the-line Super Duty model reaching $130,000. These numbers are enough to make even the most loyal truck enthusiasts pause. Soaring prices have created a divide between the trucks on the lots and the buyers who once lined up to purchase them. High sticker prices not only deter first-time buyers, but also alienate long-time customers who have seen prices rise year after year. For many, the dream of owning a new truck is slipping out of reach. What's driving these costs? Manufacturers point to rising production expenses, including advanced technology integrations, material shortages, and inflation. While these factors play a role, the frequent price increases feel more like an attempt to boost profit margins than a reflection of true costs. Buyers are left wondering whether these trucks are worth the premium. Recognizing this pricing crisis offers insight into how the industry has priced itself into a corner, leading to dwindling demand and bloated inventories. High prices might make headlines, but the incentives designed to counteract them reveal even deeper issues within the market. Incentives gone wild. Discounts were supposed to help move trucks off the lots, not destabilize the entire market. As sticker prices climbed higher, manufacturers turned to incentives to bridge the gap between their inflated costs and buyer affordability. Rebates, low-interest financing, and trade-in bonuses became the norm, luring buyers with the promise of savings. But this strategy is starting to backfire. The incentives have grown so aggressive that they now undermine the truck's perceived value. For example, a manufacturer offering $10,000 off a $70,000 truck raises questions. Was the truck overpriced to begin with? This erosion of trust impacts future sales. Buyers hold off, expecting even bigger discounts down the line, and the vicious cycle continues. Furthermore, these discounts aren't free. They eat into profit margins, leaving manufacturers scrambling to cover costs elsewhere. For some companies, like Stellantis with their Ram trucks, deep discounts have become a lifeline, pushing unsold inventory off lots. But these short-term solutions don't solve the underlying problem of waning demand. By understanding the hidden cost of these incentives, we see how they contribute to market instability, making a crash more likely. As we move forward, the struggles of individual manufacturers paint a vivid picture of a market under siege. Manufacturer-specific challenges. Even industry giants like Ford, Stellantis, and General Motors aren't immune to the pressures threatening the truck market. Ford, long seen as a symbol of dominance in the truck industry, now finds itself itself navigating treacherous waters. Its foray into electric vehicles, including the much-hyped F-150 Lightning, has been a costly venture. Reports suggest that these electric models are being sold at a loss, highlighting the challenges of competing in a market that demands innovation without sacrificing profitability. Compounding these financial struggles are rising recall rates and ongoing quality issues, which have tarnished the brand's reputation and shaken buyer confidence. Meanwhile, Stellantis, the parent company of Ram, faces its own uphill battle. The once popular Ram trucks have seen a significant decline in sales, driven by inflated pricing and a lack of meaningful innovation. Many loyal customers feel alienated by the brand's decision to phase out the beloved V8 engine in favor of a less familiar straight-six turbocharged option. Adding to their woes are rumors that Stellantis may slash prices by as much as 30% to move excess inventory, a clear sign of desperation that could send shockwaves through the entire truck market. General Motors, on the other hand, has managed to maintain relatively stable sales, but not without its own set of challenges. While models like the GMC Sierra and Chevrolet Silverado remain popular, their high price tags raise questions about sustainability. GM has attempted to embrace electric vehicles as well, but these ventures are far from turning a profit. Even with strong branding and loyal customers, GM finds itself walking a fine line between maintaining market share and adapting to an industry in flux. By examining the individual struggles of these manufacturers, it becomes clear that the issues plaguing the truck market are systemic rather than isolated. These challenges only scratch the surface of what's driving the truck market toward an inevitable crash, as we'll see when we delve into the broader economic trends fueling the crisis. Economic shifts undermining truck sales, rising costs and shrinking wallets. Could this be the financial squeeze that triggers the truck market's downfall? The economic foundation supporting the truck market is beginning to show serious cracks. Over the past few years, inflation and skyrocketing interest rates have made it significantly harder for the average consumer to afford new trucks. With the average price of a mid-range truck exceeding $70,000, even loyal buyers are walking away. The problem doesn't stop with consumers. Automakers are feeling the pinch too. The cost of materials like steel and aluminum has surged, while global supply chain disruptions continue to drive up manufacturing expenses. Adding to this are climbing labor costs and the expenses of integrating advanced technologies like electric powertrains and autonomous features. The result? Truck production is more expensive than ever, and profit margins are shrinking fast. Understanding how economic shifts directly impact the affordability of trucks and the industry's future will empower you to navigate this volatile market. What about fleet buyers? Traditionally, rental companies and government agencies provided a reliable safety net for manufacturers during downturns. But even this market is shifting. Many fleet managers are now holding onto older vehicles longer, opting for repairs over replacements. This shift creates an oversupply of new trucks, compounding the challenges facing the industry. While rising costs strain buyers and manufacturers, another massive issue looms over the truck market: overproduction. The overproduction crisis. Rows of unsold trucks fill dealership lots. Why can't automakers stop flooding the market? Overproduction is one of the most glaring issues driving the truck market toward collapse. For years, manufacturers ramped up production, chasing record-breaking sales figures. But the surge in inventory has now created a bottleneck. Drive past any dealership and the signs are impossible to miss. Rows of unsold trucks, from entry-level models to fully loaded high-end options. This isn't just a logistical headache, it's a financial nightmare. Unsold inventory ties up resources, drives down residual values, and forces manufacturers to offer aggressive discounts. For automakers like Ford and Stellantis, the stakes are even higher. Both companies have invested heavily in electric and hybrid trucks, betting big on a future that hasn't materialized as expected. The result? State-of-the-art production facilities risk turning into financial liabilities. You'll gain insight into why overproduction could lead to deals for buyers, but chaos for automakers. Even fleet sales, a traditional fallback, are no longer reliable. Companies are scaling back large purchases, instead choosing to extend the lifespans of their vehicles. For automakers, this eliminates another crucial revenue stream. If overproduction paints a dire picture, the challenges posed by electric trucks add even more complexity. The role of electric trucks in the downturn. Electric trucks were supposed to be the future, so why are they dragging the industry down? Electric trucks represent a double-edged sword for manufacturers. On one side, they signal innovation and sustainability. On the other, they are costly to produce, and their high price tags deter many buyers. Take Ford's F-150 Lightning. Despite initial enthusiasm, its sales have stagnated. Reports indicate Ford loses tens of thousands of dollars on every Lightning sold, highlighting the financial burden of electrification. Stellantis isn't faring much better with its Ram Revolution EV. Though the vehicle offers cutting-edge features, the lack of widespread charging infrastructure makes many buyers hesitant. For truck owners who depend on reliability and convenience, the range limitations of electric models can be deal breakers. Learn why electric trucks are caught between innovation and profitability, and what that means for buyers. Even General Motors' flagship GMC Hummer EV, a technological marvel, suffers from a steep price tag that has relegated it to niche status. These struggles underscore a broader industry dilemma. Automakers are investing billions in electrification, but the short-term financial returns are disappointing. While the electric truck conundrum challenges innovation, it's creating ripples in the used truck market, making the situation even more precarious. Ripple effects on the used truck market. The used truck market has always been a safe bet until now. The turmoil in the new truck market is spilling over into the used sector with alarming consequences. Traditionally, used trucks were a more affordable alternative, offering similar utility at a lower price. But declining residual values for new trucks have disrupted this dynamic. As manufacturers slash prices to clear inventory, the value of used trucks drops even faster. For consumers, this means trade-ins yield less cash, reducing their ability to upgrade. Dealers, overwhelmed with unsold trade-ins and lease returns, face plummeting profit margins. Even lenders are vulnerable. With vehicles depreciating faster, loans become riskier, increasing the likelihood of defaults. Discover how these shifts in the used truck market might present opportunities and risks for savvy buyers. The cascading effects are reshaping the entire industry. When the backbone of the market, used vehicles, starts to wobble, it signals deeper systemic issues that could take years to resolve. The interconnected challenges facing the truck market demand a closer look at the broader forces shaping the industry's future. How rising debt is fueling the collapse. What happens when consumers can't afford their dream trucks anymore? Debt might just be the final nail in the coffin. Debt has become a ticking time bomb in the automotive industry, and nowhere is this more evident than in the truck market. With the average cost of a new truck now soaring past $70,000, many buyers have turned to long-term loans to afford their purchases. It's not uncommon to see 6 or even 7-year loan terms being used to spread out the payments. While these extended loans lower monthly costs in the short term, they carry hidden risks. Over the life of these loans, buyers end up paying far more in interest than they would with traditional financing. Worse still, as trucks depreciate rapidly, many owners find themselves upside down, owing more than their vehicle is worth. This creates a financial trap. If they need to sell or trade in their truck, they're stuck with a loan balance they can't cover. The ripple effects extend beyond individual consumers. Banks and financial institutions are feeling the heat too. Rising delinquencies on auto loans have already begun to spike, and industry analysts predict this trend will worsen. Lenders, once eager to approve large loans for truck buyers, are now tightening their requirements, making it even harder for potential buyers to enter the market. By understanding how debt dynamics affect the truck market, you'll be better equipped to spot opportunities and avoid financial pitfalls. The combination of high vehicle costs and rising interest rates has created a perfect storm, with fewer buyers qualifying for loans and those who do borrowing less. The once booming truck market is heading towards stagnation. This financial crunch could be the tipping point that accelerates the industry's decline. While consumer debt reveals cracks in demand, the cost of maintaining and repairing these expensive trucks only adds to the pressure. Maintenance costs and long-term ownership woes. Trucks are built to last, but can owners afford to keep them on the road? Trucks are renowned for their durability, but maintaining one has become an expensive proposition as automakers integrate more advanced technology into their vehicles. Repair costs have skyrocketed. Features like adaptive cruise control, advanced towing systems, and hybrid powertrains require specialized tools and expertise, making even routine repairs a costly affair. For example, replacing a headlight on a modern truck equipped with advanced LED technology can cost several $100s, while repairing a cracked infotainment screen may run into the thousands. These costs are pushing many truck owners to reconsider their decision to buy a new vehicle. Instead, they're choosing to hold on to their current trucks for longer, opting for repairs over replacements. The aftermarket industry is experiencing a boom as a result, with parts suppliers and independent mechanics benefiting from the trend. However, this shift is a double-edged sword for manufacturers. While it helps reduce the pressure on their new inventory, it also undercuts the demand for new trucks. Learning how maintenance costs affect truck ownership gives you insight into why buyers are hesitant to make new purchases, and how this trend impacts the industry. The rising cost of parts is another factor driving up maintenance expenses. Supply chain disruptions and increased material costs have made everything from brake pads to tires more expensive. For fleet operators who depend on multiple vehicles to keep their businesses running, these costs add up quickly, straining already thin profit margins. If high maintenance costs weren't enough, competition from used trucks and alternative transportation options is reshaping buyer behavior. The rise of alternative transportation solutions. Are alternative options stealing the thunder from traditional trucks? The growing popularity of alternative transportation solutions is adding yet another layer of complexity to the truck market. Ride-sharing services, vehicle subscription programs, and even short-term truck rentals are gaining traction among consumers who no longer see the value in owning a truck outright. For businesses, leasing fleets or opting for trucks-as-a-service models offers flexibility without the long-term financial commitment of purchasing vehicles. These models allow companies to upgrade to newer trucks as needed, reducing the burden of maintenance and depreciation. For individual buyers, subscription services provide access to a range of vehicles, including trucks, without the hassle of ownership. Exploring these alternatives opens up a world of possibilities for those looking to save money or adapt to changing transportation needs. Electric vehicle manufacturers like Rivian and Tesla are also shaking up the market. While their offerings are premium priced, they come with perks like lower maintenance costs and access to exclusive charging networks. This innovation has attracted a subset of buyers who value cutting-edge technology over traditional ownership experiences. Meanwhile, public transportation and urban planning initiatives are reducing the need for large personal vehicles in densely populated areas. For rural buyers, these trends may seem irrelevant, but for urban dwellers, they're making trucks less essential. As alternative options gain momentum, let's talk about how the broader cultural shift towards sustainability is reshaping the truck industry. Sustainability and the shift in consumer values. Are traditional trucks losing their appeal in a world that prioritizes sustainability? Consumer attitudes towards sustainability are evolving, and the truck market is feeling the effects. Younger buyers, in particular, are less likely to purchase gas-guzzling vehicles, opting instead for more fuel-efficient or electric models. For years, trucks symbolized rugged individualism and utility, but as environmental concerns grow, their reputation as fuel-hungry behemoths is becoming a liability. Manufacturers are scrambling to address these concerns by launching hybrid and electric models. However, these efforts often come with trade-offs. Electric trucks have limited range, and hybrid models still rely on gasoline. Additionally, the infrastructure for charging electric trucks, especially in rural areas, remains underdeveloped. Understanding the role of sustainability in shaping consumer preferences allows you to anticipate future trends and make informed decisions. Sustainability isn't just about emissions, it's also about materials. Some automakers are exploring the use of recycled or sustainable materials in their truck designs. While these initiatives are commendable, they often lead to higher production costs, further driving up prices for consumers. Cultural shifts are also influencing buying habits. The younger generation places a higher value on experiences and minimalism, which doesn't always align with truck ownership. Instead of purchasing a vehicle, they might opt for shared ownership models or prioritize eco-friendly alternatives. With changing values, rising debt, and alternative solutions reshaping the market, one has to wonder, how will the truck market evolve in the coming years? The impact of global market trends on trucks. How does the global economy dictate the fate of the US truck market? The truck market doesn't exist in a vacuum. It's heavily influenced by global economic trends, and recent developments have created a challenging environment for manufacturers and buyers alike. Factors such as fluctuating oil prices, international trade disputes, and raw material shortages have placed significant pressure on production costs. Take steel and aluminum, for example, two materials essential for truck manufacturing. Tariffs on imports, coupled with increased global demand, have driven prices sky high. This has directly impacted the cost of trucks, making them less accessible to the average buyer. Manufacturers have had to walk a tightrope between raising prices to cover costs and trying to maintain affordability to attract buyers. Currency fluctuations also play a role. A weaker US dollar means higher costs for imported components, which many truck manufacturers rely on. Even companies that produce domestically aren't immune, as global supply chains affect everything from electronics to tires. Knowing how global trends ripple through the truck industry helps you anticipate price changes and market shifts. The truck market's heavy reliance on exports has made it vulnerable to changing trade policies. Countries that traditionally import US-made trucks are now exploring local production options, further squeezing the market. These dynamics force manufacturers to rethink their strategies, prioritizing innovation and cost efficiency over traditional growth models. While global trends paint a complex picture, the real challenges come from changing consumer preferences right here at home. The role of consumer preferences in market shifts. Are consumer preferences becoming the silent force driving the truck industry's decline? Consumer preferences are evolving rapidly, and the truck market is struggling to keep up. Where trucks were once prized for their utility and ruggedness, buyers now demand versatility, fuel efficiency, and cutting-edge technology. The market's shift toward urban living and sustainability has created a disconnect between traditional truck design and modern consumer needs. Younger buyers in particular are reshaping the industry. Millennials and Generation Z are less likely to own large vehicles, favoring compact cars or alternative modes of transportation. For them, the appeal of trucks lies more in their tech features than their towing capacity. Automakers have responded by introducing hybrid and electric options, but these haven't been enough to reverse declining interest in traditional trucks. Recognizing these shifts allows you to align your decisions with what's coming next, whether you're a buyer or an industry insider. Luxury trucks have also seen a surge in demand, but this trend is limited to a niche audience. High-end features like leather interiors and advanced infotainment systems attract affluent buyers but alienate those seeking affordability. As a result, middle-class consumers, who once formed the backbone of the truck market, are left with fewer viable options. Changing preferences are only part of the story. The role of government regulations adds another layer of complexity. Regulatory pressures and their influence on the industry. What happens when the government reshapes the rules of the game? Regulations aimed at improving fuel efficiency and reducing emissions have placed immense pressure on truck manufacturers. While these policies are essential for combating climate change, they also increase production costs, which are inevitably passed on to consumers. For example, new standards for diesel engines have led to higher prices and reduced availability of certain models. Additionally, stricter emissions rules have made compliance more challenging for older vehicles, forcing some businesses to retire their fleets prematurely. These changes have created an uneven playing field where larger companies can adapt more easily than smaller operators. Understanding the regulatory landscape gives you a clearer picture of the challenges manufacturers face and how these might impact prices. Safety regulations are another factor shaping the market. Features like lane keeping assistance and automatic emergency braking are becoming standard, but they add to the overall cost of production. While these advancements benefit consumers, they also contribute to the growing affordability gap that has plagued the industry. With regulations tightening and preferences shifting, it's clear the truck market is on the brink of transformation. But what does the future hold for manufacturers and buyers? What's next for the truck market? Are we witnessing the end of the traditional truck era or its next big evolution? The truck market stands at a crossroads. Manufacturers are grappling with rising costs, shifting consumer demands, and intensifying competition from alternative transportation solutions. Yet, in the face of these challenges, innovation offers a glimmer of hope. Autonomous trucks are one potential game changer. While still in the testing phase, self-driving technology could revolutionize logistics and fleet operations, reducing labor costs and increasing efficiency. However, this technology is years away from widespread adoption, leaving the current market in a precarious position. By looking ahead, you can prepare for the opportunities and challenges that will define the next era of trucking. Another area of potential growth lies in modular design. Trucks that can adapt to different needs, such as swapping out beds for storage units or adding electric powertrains, could appeal to a broader audience. Manufacturers who embrace flexibility and customization might find a way to revive consumer interest. Despite these possibilities, the path forward isn't clear. The next few years will determine whether the industry can adapt to changing circumstances circumstances or face further decline. One thing is certain, the truck market of the future will look very different from what we know today. The truck market is undergoing seismic changes, and 2025 may mark the beginning of a new era. What do you think about the challenges facing the industry? Have rising costs, debt, or alternative solutions affected your perspective on buying a truck? Let us know in the comments below. We'd love to hear your thoughts.